Okay, let's work through a few example problems from chapter 22. This chapter has introduced you to the concepts of looking at costs by their behavior, whether they are a variable cost or a fixed cost or a cost that kind of has elements of both behavior, and that's what we call a mixed cost. Taking a look at this first problem, this is going to have us thinking about costs from this new perspective. So this furniture company incurred the following costs. The first one they incurred was wood used in the production of furniture. If this company is making furniture, they're producing it, any wood used in the manufacture of the furniture is going to be a variable cost, which means it varies with the level of activity. And the level of activity here is making furniture. And the more furniture produced, the more the wood costs go up. So wood is going to be a variable cost. Fuel used in delivery trucks. This is also going to be a variable cost because the more the delivery trucks drive, the more the fuel costs go up. So it acts in a variable manner. This is a variable cost. Straight line depreciation on the factory building. If you recall, straight line depreciation means the same amount of depreciation is recorded every accounting period. And this means that the depreciation does not change as the amount of furniture produced changes. Thus, depreciation is fixed. It does not change regardless of any type of activity change. Screws used in the production of furniture. Screws that are used to produce furniture, the more furniture produced, the more screws will be needed and used, so screws are a variable cost. Sales staff salaries. Salaries are a set amount. It does not change regardless of the number of hours the sales staff works. Thus, sales staff salaries is a fixed cost. It changes the same, it stays the same regardless of how the activity changes. Sales commissions. The commissions means the more the sales staff sells, the more they earn. Thus, the sales commission cost is variable. It changes as the level of activity changes. Property taxes. Property taxes are a fixed cost. They do not change regardless of how much in sales or how much is produced. It stays the same. It is fixed. Insurance on buildings. Insurance incurred on buildings is also fixed. The insurance rates stay the same regardless of how much furniture is produced or how much the sales staff sells. Hourly wages of furniture craftsmen. Hourly wages are variable. The more produced, the more the wages go up. It is a variable cost. Salaries of factory supervisors. Supervisors' salaries are the same regardless of how much they work. They are a fixed cost. They do not change as the level of activity changes. Utilities expense. Utilities expense consists of two parts. The bill consists of a connection fee as well as the usage fee. The connection fee is fixed. Regardless of the amount of utilities used, the connection fee stays the same month to month. However, the more usage of utilities, electricity, water, etc., the more the bill goes up. So utilities expense is a mixed expense. The same holds true for a telephone bill. A telephone bill has two parts to it. The connection fee to even have telephone service, as well as the usage. The more data you use, the more long distance, if you're charged long distance, or the more texting, or the more data, the more your bill goes up. So telephone bill is also a mixed cost. All right, now that you have an understanding of the difference between variable and fixed costs, now let's talk about how we deal with a mixed cost for which we need to determine how much of that cost is fixed and how much is variable. So one method we can do is using the high-low method. And what the high-low method does is it uses high activity and low activity and uses that to estimate a basic, essentially it's an algebraic equation that tells us how much of a cost in any given period of time is fixed and how much of it is variable. So we're going to use Moyne's Company. They accumulated the following data concerning a mixed cost using miles as the activity level. So here we have 4 months. We've got January, February, March, and April. For each of those months, they've given us the number of miles driven and the total cost associated with driving those miles for each of those months. Our job is to compute variable and fixed cost elements using the high-low method. So the first thing we need to do to apply the high-low method is find the highest activity data point and the lowest activity data point. Looking at our activity data points here, the highest is 8,000 miles driven and the lowest is 6,000 miles driven. We will be using March as the high data point and February as the low data point. Highest activity and lowest activity. In order to first figure out the variable portion, we are going to take the difference in the cost between our high data point and our low data point. So here we have the high data point cost and the low data point cost. The difference between those two is $2,940. Then we will divide that by the difference in the activity, 8,000 miles driven and 6,000 miles driven. The difference between those two was 2,000 miles. The difference in the cost divided by the difference in the activity of our high and low data points gives us the variable cost per activity, and this activity is in miles. Essentially what we're saying here is that for every mile driven, this particular cost will go up by $1.47. Thus, the total cost, the variable portion, is $1.47 per mile. Once we have the variable portion, we are going to take one or the other of the data points, and we are going to plug in the variable rate to determine what the fixed portion is. Okay, what do I mean by that? Let's try it first with the high data point. Remember, the total cost incurred at the high data point was $16,574. That total cost is comprised of two elements, the fixed portion and the variable portion. We know that based on our high-low method, an estimate of the variable cost is $1.47 per mile, which means when total costs of $16,574 were incurred, 8,000 miles were driven. 8,000 miles at a variable cost of $1.47 means of the total cost, $11,760 must have been the variable portion. $16,574 were the total cost with 8,000 miles driven. $11,760 of it is variable. The difference is going to be $4,814. Thus, the fixed portion, $4,814. We could do the same thing to estimate the fixed by using the low data point. Total cost incurred at the low data point, $13,634. That low data point cost was incurred when 6,000 miles were driven at a variable rate of $1.47 per mile. Total variable cost, $8,820. Total cost for $13,634. Of that total cost, $8,820 are variable, means the remainder are fixed. Notice that we got the same fixed cost when we plugged the variable cost per unit into either the high data point or low data point. Ultimately, we ended up with, for this particular cost, the mixed cost is a combination of $4,814 in fixed cost plus $1.47 per mile in variable cost. We have now broken out this particular cost based on a variable and fixed portion. The reason it's important to be able to break out a mixed cost into variable and fixed portions is that in order to apply this cost volume profit analysis, we need to be able to break all of our cost into variable cost and fixed costs. What that means is that mixed costs need to be broken out. Okay, and so now that we have a method to break our mixed cost into the variable and fixed portions, it enables us to apply cost volume profit analysis, which is what this next problem is going to have us start to think about. During the month of June, this beauty salon gave 3,750 haircut shampoos and perms at an average price of $40. During that month, fixed costs were $17,400, variable costs were 60% of sales. Okay. They would not have been able to break all of their costs into fixed and variable if they weren't able to break out their mixed cost. Okay, and that's what that high-low method did for us. Okay, so what they want us to do is to determine the contribution margin in dollars per unit and as a ratio. In total, our sales are $150,000, which is 3,750 haircuts at a price of $40 each. Our variable costs are going to be $90,000, which is the total amount of sales. Variable costs were 60% of that. $150,000 times 60% gives us variable cost of $90,000, leaving us with a contribution margin of $60,000. To calculate it on a per unit basis, we would take the selling price per unit times the variable cost per unit, which is $40 times 60%, or variable cost of $24 per unit. The sales minus the variable cost gives us a contribution margin per unit of $16. The ratio is calculated by dividing the contribution margin per unit divided by the selling price per unit. $16 divided by $40 gives us a contribution margin ratio of 40%. Okay. So taking a look at some of these amounts. Total sales minus total variable costs gives us a total contribution margin of $60,000. In other words, their June results provided $60,000 towards covering the fixed cost of the salon. Every service provided gave $16 per unit as the contribution margin. And then the ratio indicates that for every dollar in sales, 40 cents or 40% remains to help cover the fixed cost. Now we can use the contribution margin technique to compute the break-even point, both in dollars and in units. To calculate the break-even in dollars, we take the amount of fixed cost and divide by the contribution margin ratio. The ratio was 40%. Fixed cost divided by 40% gives us a break-even point in dollars of $43,500. In units, fixed cost divided by the contribution margin per unit. Fixed cost is $17,400 divided by the contribution margin per unit of $16, 1,088 units to break even. What do we interpret this as? If the company sells $43,500,
they will break even. In other words, they will have no profit or no loss. If they were to sell 1,088 services or units, they would break even as well. Finally, one more ratio or one more analysis tool we can use is to compute the margin of safety in dollars and as a ratio. Margin of safety measures what change in sales can occur before the company starts to incur a loss. And that is calculated by taking the amount of sales and subtracting out the break-even sales to get the margin of safety. Doing it in dollars, the total sales, 3,750, services sold times an average of $40, $150,000 was earned in sales. Subtract out break-even sales to get to a margin of safety in dollars. We then divide the margin of safety in dollars divided by the actual sales to get a margin of safety in ratio. In other words, what this is telling us is the salon can lose $106,500 worth of sales before they start to incur a loss. They have a 71% cushion in terms of how far they can drop before they would incur a loss.
The contribution. All right, this next problem has us thinking about this relationship of variable cost and fixed cost. Manx Company had $165,500 of net income in 2012 when the selling price per unit was $163. The variable costs were $67 per unit and fixed costs were $1,202,500. Management expects per unit data and total fixed costs to remain the same in 2013. However, the president is under pressure from stockholders to increase net income by $52,040 in the new year. First things first, they want us to figure out how many units had been sold in 2012. Remember our basic understanding of how we calculate net income. It's revenues minus expenses to get to net income. Revenues are our sales. Here we're looking at all of our expenses by variable and fixed. Net income in 2012 was $165,500. Our sales are whatever the number of units are, times $163 per unit, the selling price per unit. The variable costs are going to be however many units were sold at a variable cost of $67 per unit, minus the fixed cost. Ultimately, what we just need to do is solve for the one unknown. We just don't know the number of units. So to simplify our formula algebraically, essentially what we can do is subtract the 163 times the number of units minus the 67 times the number of units, or our contribution margin of $96 per unit, selling price minus the variable cost gives us a $96 contribution margin. The contribution margin times the number of units sold minus the fixed cost gives us net income. Algebraically, we just start solving for the unknown amount. Add $1,202,000 to each side, and then divide both sides by 96. 14,250 units must have been sold in 2012. That's the only way we would have ended up with net income of $165,500. We can then go on and answer this next question. The president is under pressure to increase net income by $52,040 in the new year. So using a variation of the break-even formula, we're able to answer the question of how many units would have to be sold to reach the stockholder desired profit level. The basic break-even formula is fixed cost divided by the contribution margin per unit, or by the contribution margin ratio. The target profit formula just slightly alters that basic formula by adding in this pre-tax target profit. Fixed cost of $1,202,500. We are adding in the desired profit, which is last year's net income plus the increase of $5,240. Fixed cost plus the desired pre-tax profit, divide by $96 per unit. Target profit of 14,792 units. In other words, this tells us they need to sell 14,792 units to increase their profits 52,040. Ultimately, what management then does is determine last year's units sold were 14,250. Can we increase sales enough to reach our new desired level that the stockholders want? Okay, moving on to the next problem. This problem, Aaron Company reports the following operating results for the month of August. We have sales of $364,000 in dollars and units, variable cost, and fixed cost. Management is considering the following independent courses of action to increase net income. They can increase the selling price by 10% with no change in variable cost. They can reduce variable cost to 62% of sales, or they can reduce fixed cost. What they want us to do is to figure out what the net income will be under each of these alternatives so that management can determine which course of action will be the best in terms of producing the highest net income. What we need to do is take a look at each of these options. The easy thing to do is to take the August results and incorporate these changes. If we increase the selling price, the current selling price is $364,000 in sales divided by the number of units, current selling price of $80 per unit. If we increase the selling price to $88, which is 10% higher, or 110% of the current selling price. Let's take a look at our new net income. Our new net income would be this new selling price of $88 times 4,550 units, 400,400 in revenues. Variable cost would be $175,190. And fixed cost, $78,910, we would end up with a net income of $146,300. In the second scenario, if we reduce variable cost to 62% of sales, net income would not be changed in this scenario, $364,000. Our variable cost would become 62% of sales. Sales of $364 times 62. Variable cost would be $225,680 minus our fixed cost of $78,910, resulting in a net income of $59,410. The last option is to reduce fixed costs by $14,120. If we reduce fixed costs will go from $78,910 down $14,120 to a new fixed cost of $64,790. Current sales minus current variable cost minus new fixed cost, resulting in a net income of $124,20. Looking at these three net incomes, Alternative 1 is the best option because it produces the highest net income. Okay, in this last problem, we're going to continue applying our understanding of the variable cost and contribution margin and fixed cost and the break-even point. In 2012, this company experienced a break-even point of $312,800. That break-even point was based on a selling price of $7 per unit and fixed cost of $109,000. In the next year, the selling price and the variable cost did not change, but the break-even point went up to $369,000. So something else changed. It must have been the fixed cost that caused the break-even point to go up. First things first, we're going to kind of work backwards with all of this information to find the variable cost per unit. So to calculate the variable cost per unit, working with what we have, they gave us the break-even point in sales. And we know the formula to calculate the break-even point in sales is fixed cost divided by the unit contribution margin, or contribution margin per unit. We can just algebraically kind of rearrange this formula such that we multiply both sides by the unit contribution margin and divide both sides by the break-even sales in units. So really we're just kind of rearranging this formula such that the unit contribution margin is going to be fixed cost divided by the break-even sales in number of units. Okay. So looking here, we have our fixed costs for the year were $109,000. And to get the break even in units, we will take the break even point in sales and divide by the selling price per unit. If I divide 312,800 by the selling price per unit, I get the number of units to break even of 44,686. If I divide my fixed cost by my break-even point in units, I get a unit contribution margin of 244. Okay. Now that I have my contribution margin, I'm able to figure out what my variable costs must have been. If my contribution margin is calculated by subtracting sales minus the variable cost, I know my selling price is $7 per unit. I'm not sure what my variable cost is per unit, but I know my contribution margin per unit is $2.44. I can figure out that my variable cost per unit must have been $4.56. Okay. So I now have my variable cost per unit. To calculate the contribution margin ratio, remember the contribution margin ratio is simply the contribution margin divided by the sales. We previously figured out my contribution margin is $2.44. Actually, I have the wrong number here, sales. $2.44 divided by $7, selling price per unit. I come up with a ratio of 35%. Let's see what happened in 2013 when the selling price and variable cost per unit did not change, but the break-even point went up to $369. They want us to figure out what the increase in fixed costs was with all these changes. Okay, so we know that everything stayed the same in 2013 except for fixed costs, which caused the break-even point to go up. In 2013, the new break-even point is $369 divided by the selling price per unit. Our break-even point in units went up to 52,714. We know that in order to calculate the break-even point in units, we take the fixed cost, divide by the contribution margin per unit. We know that the new break-even point in units is 52,714. We don't know the fixed cost, but we know the contribution margin per unit stayed at $2.44 because the selling price and variable cost per unit did not change. So the contribution margin per unit remained at $2.44. I can then solve for the unknown by multiplying both sides by $2.44, resulting in fixed cost of $128,622. If 2013's new fixed costs are $128,622, last year's fixed costs, recall, were $109, there had to have been an increase in fixed costs of $19,622. Okay. This problem was a little bit more challenging because it required you to have a good understanding of the relationships between sales, variable costs to calculate contribution margin, how we calculate break-even point, and understanding the formulas. Okay, so have all those formulas in front of you, and it does help quite a bit.